Hi, everyone, and welcome to Live with MainStreet. It's Anna Sergunina and Jim Ludwig, and we're here to answer your questions today. And we've got a whole bunch, Anna.
Hi, Jim. Hi, everyone. Happy New Year. Yes, we do. We have a good start to this year. So let's get to questions.
Okay,
All right, Jim. Yes, you're going to go first.
Thank you, Anna.
I'm going to ask questions. Hang on. I'm going to ask questions. You answer. I'm putting you on the spot. Okay. So Marsha asks if we have any opinions for stocks in 2018. Are they going to go up? Are they going to go down? What is foreign going to do versus domestic? Will emerging markets continue to be on a roll? What do you think, Jim?
Well, I think you were reading my notes with the answers, Anna, because stocks go up and down all the time.
Do they?
What's interesting is we really have not had a more than 5% major correction since March of 2009. So the old adage, the broken clock is right twice a day, is indicated in this kind of a question. At some point, there will be a correction. In the meantime, most of the forecasters, who are usually wrong, have said that stocks will continue, but at some point during the year, there'll be a pullback. That's like the broken clock is being right twice, because there's always going to be a pullback, they say. But guess what? For almost 9 years, no major pullback. The correction is more than 5%. A bear market is more than 20%. So we haven't had a bear market since 2008. Emerging markets was the best asset class for 2017. Many of the prognosticators are saying it's going to go up again. Our consistent stay the course asset allocation has been usually about 5% in emerging markets out of 60 or 70% that might be in stocks. There's no information that's come to either you or I to change people's asset allocation unless their timeline to retirement, their timeline for a big expense, if those things change, then it's time to look at your allocation to stocks. If you don't need them for a few years, no reason to change. Stay the course. Go ahead, Anna. Can I ask you a question?
Sure. You go ahead.
Okay. So Scott and Susan emailed us and said, should we have sell orders on our investments in case the market has a severe correction?
Well, they could have those orders in. It doesn't hurt, right? They don't execute until something changes. So if there's a certain price point that you set a sell order at, but I guess still coming back to the question that you answered earlier, what is that going to solve? Are these clients that are asking a question, trying to understand more background information, what are they trying to solve? Are they trying to get out of the market if it hits a certain point? Sure, but at the end, when are they going to get back in? So to answer the question, sure, go ahead and place sell orders and leave them hanging in there. But the question I have in return is, when are you going to know to get back in? How about that, Jim?
Well, Anna, to add to that, in 15 years, I've never recommended anybody have sell orders, because what happens and what the research shows is there will be an intraday drop. Remember the flash crash of a number of years ago now?
Yes, I do.
All those trades, and then you're stuck with all that cash. And at the end of the day, the market went back and you're sitting there with cash. Now, what do you do?
Right. So those things do happen, but I think these clients are getting anxious and nervous. So perhaps we should have a discussion about what's changing in their life, just like what you said earlier. If the goals changed, if the timeline of when they're going to need their investments and income from it changed, then maybe we need to adjust the allocation.
Better that than just thinking maybe the market's going to go down big, because who knows? No one knows.
Well, we do know it's going to go down. We just don't know when.
You do? You know it's going to go down? You said that in 2011, Anna. What happened?
We I don't know when, Jim. I just know that it does go up and it does go down. So let's continue with questions. We're getting off subject. Okay. So do you have a suggestion for a best bank to keep cash on hand at the moment? Interest rates have gone up a little bit. Do we have latest suggestions?
Well, I'll tell you where I'm keeping my extra cash, and that's in CIT Bank, not Citibank. In fact, their internet address is bankoncit.com. It's right now paying 1.35, but when I put money into it in August, it was only 1.3. But in September, they raised their rates. And that told me, number one, I wasn't in for a teaser rate and locked in. And number two, that I would go up if their overall rate that they're paying their savers is going up. I like that. And that's why I have a lot of cash sitting there right now, because that to me is insured, FDIC, and I have every confidence that if they raise their rates, I'll get that same rate.
Yeah, the other one, so we do like to check out a site called bankrate.com. That's where we get our latest ideas for interest rates, mortgage rates, CD rates, and things like that. So the addition to what Jim is mentioning, CIT Bank, there's another bank called Immigrant Direct Savings, and that one is at 1.5%. It's not a teaser rate. It's actually the bank that I opened my first online savings accounts when interest rates were like 5%. So I have a particular attachment to it. But there's a couple more. If you check out the bankrate.com site, you can find those. But that one is 1.5%. So
that's
perhaps a little more.
That's a good idea, Anna. Maybe I'll look at that. Thank you.
Yes. Actually, sorry, it's not Immigrant Direct. It's Dollar Savings Direct. It used to be called Immigrant Direct. So look it up. And
I have an account there still too. So there you go.
Or do you still do? I actually closed mine when interest rates went down from the 5%, but it's still the same bank. So okay. Moving right along.
At what point? This is Erwin asking this question. At what point should we consider rebalancing?
Well, Jim, it's a good question that we get asked all the time. I think for a rule of thumb, it's probably wise to look at your investments and portfolio twice a year. That's what we do for most of our clients. Some come back even more than that, just based on their needs. I think if you're facing some kind of decisions that involve pulling from your portfolio, or if you're worried about market corrections and changes, perhaps we need to look at the allocation of your portfolio. Now, something that we use when we judge, when we review the accounts and we look at the allocation and we judge and say, all right, do we need to rebalance this portfolio or not, is that if there is a change on either side, either the bond and cash component or the stocks or equities, if there's a change of 5% or more. Now, we have a special software that allows us to do those kinds of computations and come up with the overall allocation for the portfolio, right? Not just one account. So, but that's sort of a general recommendation, is when do we actually rebalance? Because if you target to keep an allocation of 60-40, and all of a sudden, because the market has grown, right, and that's what we've seen for a lot of our clients this past fall, now all of a sudden you have 65-35. And that's a different allocation, because now you all of a sudden have more in equities than you did before. Therefore, you take in more risk. So that's what I would say in terms of when and at what point to rebalance.
And Anna, to give our viewers an idea, in the spring, for our continuous clients, most of them, we didn't have any rebalancing recommendations unless something was going on in their life. This fall, I think the vast majority of our clients, we dialed them back about 5% because their equities had started creeping up over that magic 5% number. And we were a little concerned that they were taking on too much risk in this kind of a market. So that's what our experience was this year. So sometimes nothing's happening, and sometimes before you know it, you're in heavily in stocks and you didn't intend it.
Right. Okay. Moving right along with the next question for Jim. So do you have a suggestion for a best credit card to get travel miles? Somebody told me you travel a lot, Jim.
Yes. And I've got two data points on this. I subscribe to a newsletter called thepointsguy.com, and I also read Forbes online. Both of them declare recently, but at least for the last 6 months to a year, they have said the Chase Sapphire Preferred. So if you Google Forbes Chase Sapphire Preferred, or you Google thepointsguy.com Chase Sapphire Preferred, you'll find articles written on why those two authors think it's the best. However, I will tell you that I use the Chase United Mileage Plus card because I have one of those legacy cards that gives me a lot of things that the new cards don't offer. And I like those miles, and I like to fly business or first class, and that's what I use them for. So if you don't have a legacy one that was more lucrative, Chase Sapphire Preferred is the current best one.
Yes, and one site that I like too for exploring credit cards, just like bankrate.com for savings rates and mortgage rates and things like that, is nerdwallet.com. They have a great tool to help you answer a couple of questions, and they just let you know which is the best credit card. And actually, Chase Sapphire is one of those that comes up at the top of the list too. So if you specifically want to, maybe you want a cash rewards card, or maybe you want some other features, that's a good resource to use. Okay, next question, Jim.
For Anna, what's the best frequency to take RMD proceeds, required minimum distributions, if you're going to invest the remainder in your taxable account that's sort of a bucket 2 and 3 account? What's the best frequency? Is it monthly, quarterly, semi-annually, annually? When do you take the money out and reinvest it?
Well, I think I want to circle this back to the earlier question about rebalancing. So when we have clients who have RMDs coming out both ways, right? It's either a lump sum once a year, or it's a monthly check. So if you need income, and if you want to feel like you're getting a paycheck, setting up your distributions on the monthly frequency probably makes sense. If you're thinking about reinvesting the funds back into the portfolio, and perhaps it's in your taxable account, I think it's wise to set it up around the time when you're rebalancing, because that could help us do that if we're advising you on how to invest it. Jim?
Good answer, Anna. What happens is, for our gold continuous clients that we're meeting 4 times a year, if they had distributions 4 times a year, we can use that cash to rebalance, and it's only one trade. That's a buy trade. If you're a silver continuous client, where we're meeting with you twice a year, then maybe semi-annual distributions. So the cash, have a recommendation. Rebalancing, we've got just the one trade cash to do it with.
Right.
Okay, Anna.
All right, one more question for each of you to wrap it up. So should we expect a correction this quarter, Jim?
Well, it reminds me of the question that you ask in California a lot. Are you expecting an earthquake this quarter?
Oh my God, can I tell you something? We actually had an earthquake last night.
Oh no.
But I wasn't expecting it, Jim. And I felt it.
But you live in an area with earthquakes, and they happen every once in a while. It's the same way with severe corrections.
Yes.
They happen every once in a while. Maybe it's 9/11. Maybe it's the mortgage credit crisis. Those things are unknown. They're surprises. And that's what caused the market to correct. It's because people's expectations are dramatically changed. They're scared and they head for the exits. So, are you expecting a severe correction? Not this quarter. Is it going to happen sometime this year? Same way with the earthquakes. It might happen, might not. It's an unknown and it's going to be a surprise. So when we started this business 15 years ago, Anna, and when you joined me 11 years ago, did you notice that we did not have a crystal ball in the office?
Yeah, never had one. I wondered why.
Good. So the best defense is diversification, having 2 or 3 years worth of cash if you're going to need it, and then you don't have to worry about the stock market. The stock market's never been down 3 years in a row. So if you have up to 3 years worth of cash that you need to spend, then don't worry about it.
Okay. We'll just do that, Jim. We're still going to keep asking the same question. When is the correction?
Okay. Well,
we will only know
when's the earthquake coming, Anna? Because I'm not going to come visit during that time.
I don't know. I felt it, and then because I woke up and I was laying there trying to think, okay, is it going to hit again? Is it going to hit again? And I think I fell asleep, so it never hit again. So there you go.
Last question, and several people have asked this. How will the new tax law planning for those who are close to retirement and for those who are already in retirement?
Yeah, I think this is a good question, and there's lots of different areas, but I think the first thing to think is hopefully we're all going to be in lower tax brackets, right? Because there are adjustments to the current tax bracket structure. So I particularly like that. I think the other point in the whole change of for the tax law is thinking about carrying mortgages, particularly for people in high states where the values of properties are high, as California and New York, right? Remember, property tax deduction is capped at $10,000. Deduction is kept at $750,000 value of the home. So a lot of those things is something to consider. We never advocate for mortgages in retirement, but if you are having something like that, you need to think about. But I think the most exciting part is that we're going to be paying less taxes, hopefully. But it's like I think you mentioned this, or maybe Yuri was talking to me. It's like they've given us some sort of options with the new tax proposal, but then they've taken it away on this other side. So it's like give or take. So I think we're just going to come out somewhat even. Any thoughts on this, Jim?
Alternative minimum tax for a lot more people is going away. I tweeted last week a New York Times interactive website that how you can calculate your taxes under the new act. And I got more clicks on that tweet than I've ever had in probably 9 or 10 years that I've been on Twitter. Over 800 people clicked on that. And if anybody wants to get that website, and if they just Google Tax Act calculator, New York Times, they'll get to it. It's a great interactive website to judge whether you're going to be a winner or a loser under the Tax Act based on the information that you put in.
Yeah, well, I had a whipping $200 savings. I played with that calculator, and I retweeted it for you. So yes, Jim, you're welcome for contributing to your viral tweet.
Thank you. So as far as retirement planning goes, it's really individual. Rental property owners are treated differently. Also, some things that have been write-offs, like our fees, are no longer write-offs. Your CPA fees are no longer write-offs. So even if you do use deductions rather than standard, you may come up with some surprises. Remember, it was 900 pages long, and nobody read it on it. So we're waiting for webinars and seminars to come up, and as we meet with people this spring, we will be better prepared to answer that question on an individual basis. And it's going to be an interesting year as people get ready for that 2018 tax return, which you fill out in 2019.
Yes. We still have to finish 2017 taxes. So Well, that's about as much time we have, Jim, and we are out of questions. So we'll see you all next month. Think about some more exciting questions for us, and have a great day. Jim, take care, and thanks for joining us.
Thank you, Anna. Bye now.